Investing can grow your wealth, but what if there are hidden costs quietly eating into your returns? Today, we're uncovering the fees, taxes, and sneaky expenses that most investors never hear about until it's too late. From management fees to trading costs and even overlooked charges, understanding these hidden costs is crucial to keeping more of your money working for you. Today, we will talk about the hidden costs of investing nobody talks about. So before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding investment costs. When people think of investing, they often focus only on potential gains. However, investments come with various costs that can quietly reduce overall returns. These include management fees, trading commissions, taxes, inflation impact, and opportunity costs. Beginners often underestimate how these small expenses accumulate over time. Understanding the hidden costs is crucial to accurately assess net returns and make informed decisions. While some costs are unavoidable, awareness allows investors to choose more efficient options and reduce unnecessary expenses. Hidden costs can erode profits significantly over decades, making it essential to plan carefully, monitor fees, and adopt strategies that maximize long-term wealth. Knowledge of these costs ensures smarter decision-making and better control over investments. 2. Management fees and expense ratios. Mutual funds, ETFs, and other managed investments charge fees for professional management. The expense ratio represents the annual cost as a percentage of assets. Even a seemingly small fee like 0.5% to 1% can reduce compound growth over decades. For instance, a $10,000 investment with a 1% annual fee might cost thousands in lost returns over 20 years. Beginners often overlook these fees, assuming professional management is free. Choosing low-cost index funds or ETFs can reduce these hidden expenses significantly while providing similar market exposure. Understanding management fees allows investors to maximize net returns and avoid giving up a substantial portion of wealth to avoidable costs. 3. Trading commissions and transaction costs. Buying and selling stocks, ETFs, or other assets can incur trading commissions or transaction fees. Frequent trading increases these costs, which eat into returns over time. Online brokerages have reduced many fees, but some investments still carry hidden charges like bid-ask spreads or platform fees. Beginners who trade frequently without considering costs may find that these small expenses accumulate, reducing overall portfolio performance. Understanding how transaction costs work encourages strategic buying and selling, limiting unnecessary trades. Investors benefit from focusing on long-term positions, using cost-effective platforms, and being mindful of hidden transactional charges that quietly diminish returns. 4. Taxes on investments. Taxes are a major hidden cost in investing. Capital gains tax applies when you sell an asset for profit, and dividends may be taxed as income. Short-term gains often incur higher rates than long-term gains. Ignoring tax implications can drastically reduce net returns. For beginners, understanding tax efficiency is critical. Tax-advantaged accounts like IRAs, 401s, KS, or similar retirement accounts can minimize or defer taxes. Choosing investments with favorable tax treatment or planning sell strategies strategically helps investors keep more of their money. Awareness of taxes as a hidden cost ensures smarter planning, avoiding unpleasant surprises that reduce wealth accumulation over time. 5. Inflation as a hidden cost. Inflation silently reduces purchasing power, even if investments grow nominally. A portfolio earning 5% annually may appear profitable, but if inflation is 3%, real returns are only 2%. Beginners often ignore this factor, assuming nominal gains are sufficient. Protecting investments against inflation requires including assets that outpace rising prices, such as stocks, real estate, or TIPS. Understanding inflation's hidden impact emphasizes the importance of real returns, actual growth after considering the cost of living. By accounting for inflation, investors can ensure their wealth grows in purchasing power rather than merely in nominal numbers. 6. Opportunity costs. Opportunity cost is the potential gain lost by choosing one investment over another. For instance, investing in a low-return asset while higher-return options exist reduces long-term wealth accumulation. Beginners often overlook this concept, focusing on current returns rather than potential alternatives. Considering opportunity costs helps evaluate investment choices carefully, balancing risk and reward. Making deliberate decisions about allocation ensures money works optimally, rather than being tied up in less efficient assets. Opportunity cost is a hidden factor that shapes portfolio growth and long-term financial outcomes, emphasizing strategic thinking over reactive investing. 7. Behavioral costs. Investor behavior can generate hidden costs. Emotional decisions like panic selling during market downturns, chasing trends, or overtrading can erode returns. Beginners are particularly susceptible to these mistakes, which often compound over time. Behavioral costs are subtle but impactful. Fear and greed lead to suboptimal timing, reduced gains, and increased losses. Developing a disciplined, long-term strategy minimizes these costs. Awareness of psychological influences helps investors make rational, evidence-based decisions. Recognizing behavioral costs allows beginners to implement rules, automation, or guidance that mitigate emotional decisions and protect wealth over time. 8. Fees in alternative investments. Alternative investments like private equity, hedge funds, and real estate often carry high hidden costs, including performance fees, entry fees, and maintenance costs. These can significantly reduce net returns, especially when compounded over long periods. Beginners may be attracted to these investments by high potential returns, overlooking associated expenses. Understanding all fee structures before committing capital ensures transparency and informed decision-making. Careful evaluation of costs versus expected gains helps investors avoid unpleasant surprises and maintain efficient portfolio growth. Hidden fees in alternative assets can quietly erode profits if ignored, making due diligence essential. 9. The importance of transparent investing. To avoid hidden costs, investors should seek transparency in all investment products. This includes reading fund prospectuses, understanding fee structures, knowing tax implications, and evaluating operational expenses. Beginners should question unclear charges and choose low-cost, high-quality investments where possible. Transparency reduces unexpected deductions from returns and increases confidence in financial decisions. Awareness of hidden costs allows investors to make better choices, protect wealth, and maximize net returns over time. Transparent investing builds trust and empowers investors to align strategies with long-term goals. 10. Taking action to minimize hidden costs. Investors can take practical steps to reduce hidden costs. Use low-cost index funds or ETFs, limit unnecessary trading, and prioritize tax-efficient accounts. Monitor expenses regularly, understand fee structures, and avoid emotionally driven decisions. Diversification and long-term strategies help mitigate behavioral and market risks. Beginners should educate themselves continuously, review portfolios periodically, and adopt disciplined approaches to investing. Minimizing hidden costs ensures more of your money works for you, accelerating wealth growth and protecting financial goals. Awareness, planning, and discipline are key to maximizing net returns and avoiding the subtle traps that erode investment gains over time. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.